Is it harder for a self-employed person to get a loan? And that's really a good question, a question that every self-employed person should be asking themselves, especially if you're just going into self-employment. So, is it harder to get a loan? And really, I have to answer this question in two ways. In this video, I'm going to kind of go through some of the details about self-employment, why in some sense, yes, it's harder, and in other senses, no, it's not. So in the abstract, collectively, the answer is yes. There's more documentation involved. That's definitely the case. You're going to have to provide tax returns of your business, whether it's incorporated or not. You're going to have personal tax returns or business tax returns, or perhaps both. There's more hoops to jump through, and there's more gotchas. So the short answer is collectively, in the abstract, yes. But for specific individuals, that answer maybe not at all. If your business has been going, rocking along, you've been profitable, you've got a couple of years history, you could have a very smooth and easy underwriting process. And so, from an underwriting standpoint, the answer is yes. The underwriters look at, and these, when I say underwriters, really I'm talking mostly about underwriting engines. Fannie and Freddie have reduced the underwriting process, or distilled the underwriting process to an electronic process where they pull your credit, they get all of your data, your income, your assets, your credit history, and they run it through their electronic underwriting engine, and it comes back and says, based upon this overall analysis, we would do this. And then the human underwriters validate the data that we've given the machines. And when Fannie and Freddie design these systems, they have what they call layering of risk. Whereas there are different layers of risk. Your personal credit history. How faithful have you been in the past? How good have you been at handling debt? Your income history. How stable is that? How long have you been at that? What kind of assets do you have? Do you have reserves in case something goes wrong? How much do you want to borrow as a percentage of the house? Or is there equity in the house to cover any declines in value or losses? All of those things are different layers, and they're all collectively evaluated. And the type of employment you have is one of those layers. Is it self-employment, or is it employed by somebody else? And self-employment is generally a higher risk than being employed by somebody else. So all of those things collectively would say, yes, generally you could say it is harder to get a loan as a self-employed person. There's a lot more things to consider. But that doesn't mean that your situation has to be difficult. And many self-employed people aren't. Now, one of the problems people have is that, prior to the big crash, underwriters, all they had to look at basically was a tax return, and they could take that bottom line number on a tax return, adjusted gross income, and this is a little bit of hyperbole, but not much. And they could just take that adjusted gross income divided by 12, and as long as that number supported the income that was needed to qualify, that was really all they needed to do. And then the crash came in, and there's this much deeper level of scrutiny on everybody, underwriters included. And now underwriters are expected to actually be able to review tax returns, understand a business, and render a decision based upon that review. And again, the machines are still making the decision, but the underwriters now have to take this data, these tax returns, and say, is the data that we put into the machine supported by these tax returns? Now, I have a master's in tax. Taxes are extremely complicated, and not because I'm a super smart person. It's because there's so many layers of regulation and incrustation and documentation that it's very, very difficult, unless you spend a lot of time understanding these things, to take that tax return and translate it into something that can be supported. And so what underwriters then have to do is they will take a form that says, oh, this is an 1120S, it's an S corporation, so take the number on line 36 and put it here. Take the number on line 37 and put it here. And this is not a dig against them at all. It's just the system. It's the complexity, the Byzantine labyrinth that is our tax code, that they are supposed to distill in the limited amount of time that they have with these files, these forms. And so that's really what they have to do. And as a result, they don't always have a broader understanding. And so it is important that you work with someone who understands tax returns, who understands businesses, and who can help underwriters translate that. But that said, it does illustrate that underwriting for self-employed is generally going to be stricter, and therefore it is going to be harder for a self-employed person to get a loan. But don't despair, just be aware, right? Just be educated about what is involved, be educated about what your goals are and how your income plans, whether if you're moving into self-employment, how that then corresponds to your ability to get financing. And the most important thing you can do is talk to a loan professional before you make any moves, or at least before you firmly fix your expectations about housing, so that you know what's going on. Now let's talk about a few things here. I want to talk about what is the definition of a self-employed person. All of this is from a lending standpoint, from a loan, from a lender. Underwriting standpoint. This is what the underwriting guidelines dictate. 25% or more ownership in the primary source of your income. Now, there are common misconceptions here. Some people think that if I just pay myself a salary, let's say I start a business, I buy a business this year, make it whatever you want. You buy a business and you pay yourself a salary from that business. So you buy a business and you pay yourself a $100,000 salary. People think that, well, I get a W-2, and so I'm not self-employed, and that's not the case at all. Because you own 25% more of that business that then employs you with and pays you via that W-2, you are by definition self-employed. Form doesn't matter in this case. It doesn't matter if you are paying yourself as a W-2 employee or taking profit distributions periodically from the business, you are still considered self-employed. The other misconception kind of goes in the other direction. Sometimes people think, well, I'm a partner or owner in a business, so I'm automatically self-employed for underwriting purposes. And that's not the case either. As long as you don't own 25% or more of the business, you're not considered self-employed. And all of the additional requirements that come with being self-employed don't apply to you in that situation. So just be aware of that. And one strategy point here is if you're planning to become self-employed, and you're planning on financing residential real estate shortly thereafter, consider whether or not you can stay below 25% ownership until you have the financing. Because as a self-employed person, a lot of times you have some abilities to the way you structure your income. You can delay ownership until later in the process until you get your financing. And another sort of related thing is if you're planning on getting financing shortly after you get into self-employment, you might try and accelerate that. If you're working somewhere right now, you've got a salary, you might try and accelerate doing what you're going to do. But here you may want to do that also before you give notice. Because once you've given notice and an underwriter calls an employer to verify your income, it's likely that they're going to have to make mention of the fact that you've given notice and you're not going to be there in 2 weeks or 2 months or however long that is. So stay below that 25% ownership potentially if you can, if you're needing to finance. And this really mostly applies to people recently going into self-employment. Because once you've had that 2-year history, more likely 3 years before you have 2 years worth of tax data to report, then these things aren't quite as critical, aren't as important. And then finance before you technically become self-employed. Now let's talk about the income analysis of a self-employed person and some of the traps that you may fall into here. Self-employment income, as we've alluded to, generally requires 2 years of self-employment income use to qualify. And the thing that you need to be aware of is people think that, well, let's say that I become self-employed in mid-23, then by mid-25 I can be buying a house, and that may not be the case. And the reason for that is when they say 2 years self-employment history, that means 2 years of filed tax returns. So let's say you get financed, let's say you become self-employed in 2023, let's say mid-2023, then by mid-2025 you've had a 23 tax return, a 24 tax return. So you have 2 years self-employment income on a tax return, but that first year is only half a year. And very likely that income isn't going to support the average of, let's say, the subsequent year, the 2024 year. That 2023 year, you're only self-employed for half a year. And even if you started out great guns and you made lots of money, right? You made good income all throughout. You're only having half a year's worth of income to include in your average, and an underwriter is going to average that. And so then you get to that 2-year period. Let's say you're in mid 2025, the 2023, you get to mid 2024, you get to 2025. Well, you got to wait until 2026 for that 2025 income to actually be reported. So it may actually be closer to 3 years before you can qualify. So just be aware of it. There are exceptions to the 2-year rule that allow for only 1 year. You have to have at least 1 year reported on a tax return But there are exceptions that underwriters can make, but just understand that these are very subjective, and you're really pretty much at the mercy of the underwriter. But let's say for example, you're a manufacturer rep, and you've worked for somebody else, and you've sold whatever this manufacturer sells to and distributed it all, throughout your territory, and you've done a great job. And then let's say you buy your company out. Now you are self-employed, and now you don't have a 2-year history of being self-employed, but maybe you have a 2-year history of working in the same exact territory, the same exact customers, and now you've got a year under your belt, and you can go back to underwriters and say, look, I bought my existing company, it was my existing territory, I've even gotten things going better since I bought the company. They may, in that situation, allow you to finance with only 1 year's history. But again, you're really at the mercy of the underwriters, and they have no, that all of their incentives are to be careful, right? They don't really get a lot of benefit from approving. Of course, that's their job to approve good loans, and the good lenders will make sure that they're rewarding underwriters in the appropriate way, incentivizing them in the appropriate way. But human nature is such that you have to defend this exception, and so it's going to be somewhat of a high hurdle to get over. So just be aware of that. Another thing to be aware of, buying an existing business does not buy you the history of that business. You still need 2 owners. So if you buy an existing business that's been rocking along, and you just step into it and say, look, I bought the asset, I bought the stock of this company, and now I'm the owner of this corporation, and this corporation's been around for 20 years, so therefore I have 2 years self-employment history. No, you have however long ago you bought the stock of that company. That's your self-employment. And that's distinguished from the statement above. The statement above is someone who's been doing the same thing, and then he gets into ownership of doing that same thing and uses that period when he was not an owner of doing the same thing to demonstrate that, look, I've been doing the essential income generating activity for this thing for longer than 2 years. This next case is a situation where you buy a business you have no history in, you just buy the business and you think, well, this business has been going for 20 years, so therefore I have more than 2 years self-employment. No, you don't. You become self-employed when you buy the business, and now you need 2 years of reporting that business. A couple other things to be aware of. Income trends are monitored much more closely for self-employed borrowers. Underwriters will question sharp increases or decreases. So even if your income goes up sharply, that could be a problem. That will bring more requests for documentation. What's going on with this business? Because what underwriters feel safest, and this is because of the way the guidelines are written, is stability of income. They're looking for stability of income. Now, decreases are more problematic than increases, but increases may cause you some heartburn as well, because they're going to want to know, like, why did that go up so much? Is this sustainable? Even if you don't necessarily need the increase to qualify. Let's say you got along fine, you could qualify fine with last year's income, but it went way up this year. They still question that. But decreases are going to be problematic. Now generally you're going to take a 2-year average of income and use that to qualify. But if income is declining, at best they're going to take that declining year and say, okay, that's the income that you get to use. You don't get to average it. But they may look at that if it declines enough. Let's say it declines 20% or more. And they'll look at that and they may wonder, is this business sustainable as a going concern? And you're going to have to answer that question. And that could possibly derail the use of any of that income. So just be aware of that. Short-term business debt can create a big drag on underwriting income. And this is typically underwriters they're not going off of financial statements. Usually, we're not dealing with audited financial statements. Most of the people I deal with are small businesses. They don't have audited. And so underwriters are almost exclusively relying on tax returns. And there's a little line on the business tax return balance sheet that says debts or obligations, short-term obligations due in 1 year or less. Now, many businesses operate off of revolving lines of credit. You have a revolving line of credit. Let's say you use it to finance inventory buildup before Christmas. And then you get all the Christmas sales, and you get the profit from that, and you pay that way down. But at the end of December, that line of credit is always going to have a balance, because that's when you're ramping up before all your sales revenue comes in. You've had to ramp up, buy inventory, do whatever you do to get ready to sell through that Christmas season, for example. And this is just one example. It doesn't have to be Christmas related. But at the end of every year, you're typically, let's say, you're going to have a large balance. Well, from underwriting standpoint, and this is just something that is just bizarre in my mind, but it's it is a guideline, they will look at that debt and they will treat that as an expense. So let's say you have a $300,000 line of credit that you use every year. That $300,000 line of credit, even if it's paid off by the end of January, because all your revenues come in, you pay it down to zero. Every year that happens. The default is for underwriting to say, okay, I see you made $300,000 of income, but you have a $300,000 additional expense here that we have to deduct against that. Now you're down to zero. So it can be quite difficult, quite punitive. Now, if you're able to go and demonstrate that, look, this gets renewed every year, we've had a history of that, and that should not be a problem. That's generally acceptable, and they will exclude that. But just be aware of that. That's another one of those little gotchas. Another thing is earned income versus distributed income. And if you own a pass-through business, let's say you're a partnership or an S corporation, where you get taxed on whatever salary they pay you, but you also get taxed on the business income. The business income itself, the business itself is not a taxable entity. Like an S corporation doesn't get taxed as a corporation. All of that income passes through the individual. So let's say you pay yourself a $60,000 salary, but your business made another $200,000. So your overall taxable income is $260,000. But let's say for whatever reason you don't distribute that income to yourself. You left that profit in the business. That can create a problem for the business owner trying to qualify with that income, because that income wasn't distributed. That requires underwriting to do another layer of analysis to say, well, is this income really available to you? And I've seen this create problems a lot of times for small businesses who really kind of blur the distinction between the personal and the business. Let's say it's a one-man shop. For example, I have a mortgage company. And I will let income accumulate in my business checking account, not because I need it for anything. I don't have a lot of overhead. It doesn't support my business ability to continue. It's just, I just don't think about it. I just leave it in the checking or in the business account until I need it. Then I move it over to personal. And if I let that grow, then I get my K1 at the end of the year and I haven't distributed to myself a lot of income. They may look at that and say, oh yeah, you made great income, but you didn't distribute a lot of that income, so it wasn't really available to you, even though I could have grabbed it any time. And it's just as simple as doing a transfer and I get the income, it's wholly available to me. So just be aware of that. Again, that's one of those things that can be overcome by additional explanation, but these are things that will require explanation. And it's generally better not to have to explain more. And then also, tax losses don't necessarily mean negative income for underwriting purposes. You may have big losses on your business tax return. And again, this is a pass-through tax return that these losses pass through to you and reduce your income to where you may look on paper and not have much income at all. But there are many adjustments that can be made depending on the nature of your business. This typically, you're going to see depreciation and amortization. Depreciation is most people are familiar with that. If you buy big assets and then you write them off, and the tax code for many years now has favored very accelerated depreciation. So you can buy a $300,000 piece of equipment for your business that's going to last you for 10, 15 years, but you can write it all off in that first year. Well, underwriting recognizes, look, this asset's going to last you for many more years in the future, so we'll ignore these, what they call non-cash expenditures. So you may have a loss, but they can add that all back. Another situation where that might be the case is you buy a business that has a clientele. Let's say you buy an accounting firm and it has a clientele, an established clientele, and you pay a lot of money for that book of business because that's going to be repeat business. That's not a physical asset. It's an intangible asset. It's a book of business, and so instead of depreciating it, you amortize it. And that's just called amortization. That can also be added back in a similar way. One of the last things I want to touch upon is business assets for financing. Another thing just to be aware of. Again, let's take the situation of a small business like mine, and you're just not in the habit of moving money from your business account to your personal account, but then you say, oh, I'm going to buy a house. I probably need to move some money over in that account because I'm going to need those assets for down payment on the house. And so, but you do that in the midst of financing or right before financing. And then underwriting is going to look at your personal checking account and say, well, where did that $200,000 deposit come from? Oh, I just moved my money from my business. And then the question that they're going to have to satisfy themselves is, is that sudden withdrawal of capital from your business going to impair that business's ability to operate as a going concern? Now, generally, it's only a problem for small businesses, but I've seen this countless times. I've seen it with dentists. I've seen it, where they're sole proprietorship. They just have their business, and they just let assets accumulate. Not because it's strategically necessary for the business to continue, but they just never get around to moving the money. And then they go to buy a house, and they want to move $400,000 over for a down payment. And now underwriting has the alarm bells going off as, wait a minute, is that extraction of capital from the business going to hurt the business? And now you have to answer that question. And it's very difficult to answer that question in an objective way that just says, oh, check, check, check. It's a very subjective thing. So just be aware of that. Just going to give you one sort of gotcha example. This is something just to kind of make you aware of what happens in self-employment sometimes. There is a lot of form over substance sometimes in underwriting. So for example, you get a newly minted partner in a law firm, a CPA firm, some kind of consulting firm, and you've been earning income based upon your billing rate for many years, and you've been killing it, right? You've been doing a great job, and so they reward you, your company rewards you by making you a partner or an owner. If you are a 25% or more owner, now you are magically self-employed for underwriting purposes, and you probably going to be subject to at least a 1 year wait, even though this is an increase in your income, and it's manifestly so, and your ability to generate income as a partner is identical to what it was before you were made partner. You still have to earn income based upon your billing rate, but technically you are now newly self-employed. And so you may need to then wait a year or more before you're allowed to use your income that you've been building up over all these years to qualify. So just be aware of these things. None of this is meant to scare anybody off from being self-employed or from wanting to get financing as a self-employed person. There are plenty of great options and plenty of great loan officers who can help you access those options. It's just really good to be aware that being self-employed does have some extra gotchas, does have some extra hoops that you have to walk through, and can really benefit from some advanced planning. As soon as you start thinking about buying a house or becoming self-employed and buying a house, definitely talk to a loan professional who can help you through that.